Thank you, everybody, for joining us. I'm Dan Weiskopf, otherwise known as the ETF professor and lead ETF strategist for the ETF think tank. Here today, we have Jay Hatfield from InfraCap and James Baroutas from B. Riley, here to talk about markets and solutions. You know what, guys, I think we should just start right into it. And Jay, thanks for sponsoring the call, of course. Maybe if you would, because you've got such an interesting background, on Wall Street, if you could give your background, because I think it's highly relevant, both to energy as well as fixed income and, of course, equities.
Yeah, so thanks, Dan, for having us on, and thanks, Jim, for joining us. I started out my career as a CPA, was a business major, have an MBA from Wharton, worked for 15 years as an investment banker doing utilities and MLPs, worked for 6 years for hedge funds, most notably Steve Cohen, launched my own firm in 2008 with seed capital from him. But instead, because 2008 was terrible for raising capital, we launched I worked together with a ex-client who was the co-founder of Energy Transfer, and we formed an MLP, took it public in 2011, and then we launched our 4 ETFs over since 2011, and we also have a hedge fund. So that's my background.
Cool, thanks. And James, if you could give your background, of course, and that would be great too.
I've been a financial advisor since 1984, so I'm approaching 38 years. I was a limited partner at Oppenheimer and Company on the international side. I worked at Dillon Reed. I spent 12 years at Merrill Lynch as an international financial advisor, and I'm currently managing director at B. Riley Wealth Management. And my client base basically is high net worth, family office, and institutional clients. So, my mandate is to be a strong gatekeeper to, the intellectual capacity of the firm and to the product line that's available on the street in general. And to that end, these are challenging times
where experience really matters. So that's great. So Jay, people are looking for answers, and whether they know it or not, they're exposed to the market. So they've got an opinion, right? Let's hear about your outlook.
Yeah, so I think just to focus on our differentiated views, we've been thinking for really last week or two that we're making a bottom with regard to the Ukraine crisis. Somewhere, in terms of our own trading, we'd probably say 4150 on the S&P, but you don't get to redo these every day, and obviously we change our thinking, so you could say 4,000. But if you look at the Dow, which we tend to focus on because it's really you can make your own estimates because there are only 30 companies, and you eliminate the Teslas of the world. So in other words, you shouldn't sell your JP Morgan because Tesla's overvalued and it's in the S&P. So the Dow's trading about 17 times, which if you assume that interest rates are capped, which we'll talk about in a second, that's very, very attractive. Like the fair value with 10-year at 10% is probably 20 times. So we think we've priced most of the Ukraine situation in. Even if there's no peace agreement, there's rumors of peace agreement. I'll just hit real quickly on oil, because that right now, for the first time in probably 10 years, the market's really trading on oil, which is strange, but inversely to oil. So I think that's really what got the futures rocking today, as oil came off its highs. With regard to oil, we had been saying 80 to 100, which sounds kind of way wrong, but we've been saying, higher and higher ranges for 2 years, really, since the pandemic, when we hit negative 37. So we were actually very bullish, and people might have said, oh, 80 to 100, that's crazy. Of course, Russia, the facts are Russia has 6 million barrels, or 6% of the market in terms of exports. They produce 10, but they use 4, so they export 6. Some of that's being impaired because of a global cancellation of Russia. So it's actually more effective, really, than sanctions on oil exports, as they've just been canceled. They can't. So the global traders can't get financing. So that's why you see oil higher. Having said that, supply and demand do operate. So now we're saying this is a little bit of a wimpy range, but oil should trade 100 to 150, which sounds kind of irrelevant because it's a wide range. But keep in mind that the middle of the range is a good inflection point. And you've seen that where oil right now is off 5% or like $8 off this 125 level. So 125 is a pretty big resistance level. You saw that overnight 3 days ago where it spiked to 125. So right now, market is just gyrating around kind of inversely with respect to oil. And then just last point on the macro side is that we do have this non-consensus view that the 10-year is capped at 2%. And of course, we're not claiming victory just because there was a war in Ukraine. So we traded off 2% because of the war. But what we're focused on is 3 quick facts: 52 trillion in global pension assets, 32 in the United States, underallocated to bonds. So when treasuries trade off a lot, there'll be not only a reallocation, but also not only a rebalancing, but a reallocation. So in other words, if CalPERS is 25% bonds and their bogey's 6 and the 30-year starts to get over 2.5, they're going to say, well, why don't we have 32% bonds or 35, which doesn't sound like a big change, but these are multiple $100 billion funds. So that's point one, global pension assets. Point two is that the yield curve tends to flatten, which particularly retail investors just say, oh, the Fed's raising rates. They don't realize that the long end could actually come in while the short end goes up. And that's why you get inversions sometimes. And then the last quick point is that now it's kind of obvious, but we've been bearish about growth in Europe because of their failed energy transition. They failed to provide for enough natural gas, which is the cleanest fuel, and the best way to transport hydrogen is through natural gas. And so Europe, slow growth, China, slow growth, and in the US, nobody's focused on it, but dramatically lower federal spending in the US. So 3 reasons why we think 10-year capped, which is a critical call, because if we're wrong about that, then the market could have more downside, because rates affect all stocks, not just tech stocks, that's an urban myth, but all stocks. So we're pretty constructive about both, in terms of the asset classes we focus on, preferred stocks, defensive dividend stocks, and even MLPs, because they've gone up, but they haven't skyrocketed like the producers like Devon and Chevron. So like today, last I checked, those stocks are kind of flat, even though oil is way off, and energy stocks have actually rallied back a little bit too. But so they're a defensive way to play inflation, and this global disruption is through these pipeline companies, MLPs and pipelines.
So does that mean that you've got an inflation call where it's going to be peaking soon, or what are your thoughts specifically about inflation?
So we've been, if you look back at our press, we were really super hawkish about inflation, thought that the Fed was completely out to lunch. The Fed is really mostly Keynesians. They tend to focus on the cost side and ignore the monetary side. We're not extreme monetarists, but I was trained by a monetarist at the University of California. So extreme monetarists would say if you increase the monetary base 82%, you get 82% inflation. We haven't had that yet, but you're going to get higher inflation. So weak monetarism works at its extremes. And so we were super bearish on inflation. But now the other key point, and if you get nothing more out of this call, if you haven't already focused on this, is if you're going to call the economy, focus on 3 things: housing, housing, and housing. The Fed has caused every single recession we've had since World War II, except for the pandemic, but ignoring the pandemic, caused every single recession, raised rates, and the sector that crashes is housing every single time. So guess what? If they're going to create a boom, what do you think is the primary transmission mechanism? Housing. So housing was up 20%. That's a bubble. That's the highest ever. Rents up double digits, and consumer spending higher, because consumers tend to look not just at their stocks, but also their houses. They borrow money from them. They feel richer. If they move to a new house, they buy consumer durables. So the Fed overheated the economy, in our view, the more monetarist view, through the housing sector. And then we also had this energy inflation. So those are the two sectors we're focused on. Both of those are likely to, it's not an easy call right now, but to attenuate. Like supply and demand, people are going to forget with oil, supply and demand does operate at $125, $150 a barrel. You're going to get conservation. You're going to get more production, and it's likely to go back closer to our 80 to 100. So we think the first half, so that's an easy call now because it's going to be bad for 3 to 4 months with energy skyrocketing. First half's going to be bad. Then second half, you're going to have housing slow down. Keep in mind, mortgage rates have gone from all-time low 280 to about 410. Housing will slow down, and then demand will attenuate, and the Fed is going to be shrinking the balance sheet, which if you're a monetarist, that does matter. Doesn't matter to Powell and the Keynesians, but that'll make Bullard happy, the last standing monetarist on the Fed.
So James, hearing all this, and with 38 years of experience, what are you telling your clients about markets and inflation? And I know you must be doing a lot of hand holding right now.
It's the behavioral side of investing, drives performance on the retail side, even more so than making correct market calls tactically. Job number one is to make sure that the clients stay on message to what's suitable and appropriate in regards to what their allocation is, and to make sure that we reaffirm their time horizon. And to be, true investors rather than simply responders to headline risk. So clients are concerned about inflation because they see it not only at the pump and not only in their foodstuff purchases, but they see it everywhere. And their backdrop is that the Fed is behind the curve. They've printed a lot of money. You have supply chain disruptions, which are inflationary. You have embargoes that are inflationary. And that there's a reversal of this whole globalization theme that took place for a couple of decades. The move is towards nationalism, which is also inflationary. So they see very fundamental, ground up inflationary forces, and they conclude that the only solution to that is higher rates, which puts my bonds at risk, and dislocation in the bond market at a time when I'm not really being compensated for the inflation risk in terms of nominal rates. So they're confused. They're between a rock and a hard place. And they're also concerned because, like Jay said, the Fed's solution to inflation ultimately is a recession. That's usually the prescription. So, you fear inflation, but you also fear the solution. So clients are trying to toggle that and trying to, find spaces that are not as sensitive to interest rate inclines and yet, can answer to the inflation problem and get some return.
I was talking to a client the other day who was candidly panicky, and he's like, "I want to raise more cash. I want to raise more cash." Jay, cash is trash, or cash is what these days? Because if you've got an inflationary situation, it's almost like a guarantee to lock in a loss. No?
Correct. And we don't advise necessarily that long-term investors maintain a lot of cash. If you're trying to trade the market, the best hedge to your portfolio is, of course, selling. I know that from trying to hedge with dirty hedges, and you ultimately always lose. But if you sell, you've capped your losses. But we don't recommend that. So I manage, I'm not in Jim's business, but I manage my mother-in-law's account, which I should probably give to Jim, but because it's not that fun, and it's extremely not lucrative, zero. But the way that we deal with the fears that come from clients, actually she's valuable, because if she says that she really should sell her whole portfolio, that's probably when you should buy. She did that right before the pandemic when the Fed intervened in the pandemic on that Monday. But the point being, what I do is I focus her on the income from the portfolio, which I have her portfolio structured with about a 4.5% dividend yield. So she doesn't fully buy this, but I said, well, it's actually great that these securities have come in because you actually have a lot of other pensions. So you have free cash flow, so you can invest that your dividends and get this tremendous, I mean, not just 4.5, like our funds tend to yield 6 to 9, but have high yields and invest at lower prices. In fact, we added to one of our funds substantially. I was trading below NAV and it was off a couple bucks from its highs. So we viewed that as a huge opportunity. Whereas if you're in a bunch of momentum stocks, like if you're in Tesla and it goes from 1,200 to 800, I would think people would be just as likely to sell it as buy it because it kind of looks like it's going to 400. So that's our solution to keep people long-term focused, is to have substantial income. And then either whether you need the money for your expenses or if you can reinvest it, like I said, you're fine with the market coming in because you have all this cash flow that can cover your expenses and or being reinvested.
You've got a lot of experience beyond just energy, right, on preferreds.
Right.
Talk to us about the preferred marketplace a bit, because I think it's a niche or specialized area that a lot of folks kind of ignore.
Right. Well, we love the preferred stock area for 2 or 3 reasons. The first thing that we love the $25 preferred because it's listed. A lot of bonds are not listed. And this may be shocking to you, but when you trade with Wall Street and Wall Street traders, they're more concerned about their profits than your profits. So it's better to interact with public markets where you can put in limit orders and split the bid and ask. So we love that they're public, so you can see them on Barron's as well. And what's really great about them, and I know this from being an investment banker, the companies care about their credit ratings. Private companies often don't. They're run by private equity firms. They just want to get cash out, give it back to their investors. But public companies are run by management teams and boards that probably make more money from their compensation than they do necessarily from their equity. They care about their equity, they're public. And so they tell the rating agencies, they're BBB companies, and they'll do basically anything to maintain that credit. So then the preferreds might be non-investment grade BB, but you're on the same team with the management team. And that's what we saw during the pandemic, is they actually often shut down their common dividends, but kept paying the preferred because they don't want to go to their counterparties, whether it be their customers or the rating agency, say, oh, we have a great credit, but by the way, we're not paying our preferred dividends, which are a fixed income obligation, albeit stock. So that's why we really love it, is you can get these great securities that are issued by companies that care about their credit. They're publicly traded, which can be disconcerting. But then when you get these panics like we had in preferreds, like that's why we are adding to them. You'll see that on the filings at the end of the quarter, because they don't go on sale that often. So you have to take advantage of it because they're going to continue to pay almost every single one. Of course, we're monitoring for that. They're going to continue to pay. So if they're on sale, that's a wonderful time to buy and add to your income.
Yeah. So Jim, in the way of preferreds, how do you explain to clients about the preferred market? I mean, do they understand how the preferred market works?
Yeah, it's fairly straightforward. So basically, you have a security that generates outsized income that doesn't really correlate to the curve, doesn't really correlate to interest rates. It correlates more to the equity market. So our view has been that the economy is strong. Our view is that the leading indicators are strong and that the odds of a recession are not in the offing based on the visibility that we currently have. So we want to try to generate income from instruments that are less geared to rising rates and more geared to a good economy. And in the preferred market, you kind of get that. You get outsized returns and you don't get the correlation to interest rates as much. Basically, you have liquidity, you have transparency. The companies that you buy the preferred from are companies that you're obviously comfortable in owning. the names that you typically will know, and in industries and sectors that you're comfortable with that fit with where the economic cycle is. And it's a way to generate income at a time when rates are historically low and rising. So, clients have embraced the preferred exposure that we've shown them, and they've had success in it. So, and if you can buy, like Jay said, there are times when market volatility allows you to buy some of these at below 25, which means that the initial coupon is higher on a current basis, and ultimately they may get called at 25. So you have a better total return than simply what your income is. There's definitely an opportunity for a sleeve of your income allocation to be in preferreds.
Yeah, you brought up a great point, James. I'm the guy who always talks about how structure matters. And Jay, I know you honed in on preferreds, but you also are focused on the REIT market in the way of preferreds. Talk to us about two things. One, the REIT market in preferreds, but then also with what James brought up about the callable feature on preferreds. And this is part of the reason why you have to know what you're doing.
Mm-hmm. Well, there's a misconception about REITs because everybody follows public developers, obviously President Trump, but others, who get into trouble on certain buildings because they lever the building 70, 75% or more. But what's wonderful about REITs, and I learned this as a banker at Morgan Stanley because we would pitch REITs to some of our clients every once in a while. And we would go to the banker and say, oh, look how great this looks for the equity with 60% leverage. And they'd say, no, we don't do that. This is sold to retail investors. We do 40% leverage. So this is the unappreciated fact. You have these REITs are great credits. They're under-levered real estate. And real estate is an attractive asset to lend money against because it's not just a building, like the building that's behind me is a hotel, but maybe that hotel isn't going to do well. Well, guess what? It's sitting in Midtown Manhattan. It has a great franchise that can be converted to office, can be converted to condos. So there's a floor value on real estate. So really great collateral. So that's why we've focused on REIT preferreds because they're just generically great credits. And by the way, you can dislike the equity of a REIT, but still like the preferreds because they're 6, 7, 8 times covered with assets. So even if you don't think the equity is going to be a great investment, the preferreds can be totally fine. And then to your point, the great news about $25 preferreds is they're listed, so you can trade with other holders and not the street. But the bad news is they're callable at par, and that's why issuers like them because they have attractive balance sheet management characteristics. So you have to manage that call feature, which we really love in an active fund because there's big passive funds. They don't care about the call features, not because they're dumb or anything. It's just they're not allowed to because they don't have any smart beta. So we'll sell them preferreds at 26, 27 that are callable at 25 in the near future and book gains, which if we didn't have these index funds, we wouldn't be able to do that. And then we recycle them. So we're able to add some alpha and add some capital gains to, the dividends, which are already attractive. So we like that. And then just last point, so we don't forget it, without risk, there's no return. So preferreds have had superior returns, but what you don't want to do is be in a distressed preferred because it is preferred stock and stock is junior to bonds. So if you're going to play distressed credits, you go into even the secured bonds or unsecured bonds and they get equity and the preferred gets wiped out. So active management is important because if you have a distressed credit, you really should sell it and not buy it, which is, counter to a lot of, what I've been saying is, it's down, should buy it because it's not out. But if it's out, like in other words, it might go bankrupt, you sell it. So there were a couple of bankruptcies, we avoided them. There was B or low quality enclosed malls, and 2 of those went Chapter 11, and the preferreds traded way down. So you've got to have good credits, not marginal credits with preferreds.
Yeah, again, you got to know what you're doing, right? So Jim, talk to us a little bit about the equity markets and your thoughts, given your experience with your clients. Are people really looking to play defense, and how are they doing it, and how are you doing it? Is it focused on dividends over growth?
Right. So the psychology currently with the retail investor is fear. It's to play defense. It's to protect capital. So our conversations revolve around, again, what is your time horizon? What is your allocation that allows you to sleep at night first and foremost? And then we can talk about what's optimal, from a textbook perspective. And in terms of executing the part that's optimal, we've been focusing in on more defensive value type of names, names that have some cyclicality to them, because we are now in a new paradigm, as they say. Stocks don't go down because they went up. They change direction because there's a change of condition. We've had a change of condition. We went from loose monetary policy to more restrictive policy. The market doesn't care about good or bad. It cares about better or worse. So if we're in an environment where there's less liquidity, so to speak, there's a less accommodative Fed, then you want to avoid long-dated assets, whether they're on the fixed income side or on the equity side. It's textbook stuff. So we want to concentrate on names that have high quality, great earnings profile, strong cash flows, limited leverage on their balance sheet, and throw off income. Yeah. And if you have some time horizon between the income that you get and the appreciated growth of the portfolio over a period of time, we think that that's the most sane way to approach the insane environment that we're in a
stable way. That's the key. Right? Yeah. No. So, Jay, coming back to you in the context of the Fed, right? We're up against a Fed meeting coming up. They're going to raise rates, and what's your thinking on overall Fed policy through the end of the year?
We're more bullish than the market about Fed policy. And I'm going to give you the facts, and I would recommend everybody focus on the facts and not the opinions, because that's what, and then you can draw your own opinion. But what hasn't been focused on is that 5 out of the 7 permanent voting members of the FOMC will be Democratic appointees and unambiguously dovish relative to the rest of the board. 3 of those nominees have not yet been confirmed. But Powell is a consummate politician and will consult with them. So we don't think the Fed's going to try to cause a recession. And by the way, the track record of that is there's been 19 Fed tightenings since World War II, 11 recessions, and 8 soft landings. So to the extent that you're worried about a recession, that's relevant. So the question is, how hawkish are they going to be? Are they going to try to get us to the 2% target, which, by the way, is completely unsubstantiated? There's no rationale for that. They just made it up. Are they going to stick to that, or are they going to be more like, be patient? That's the key issue. We think, and if you listen to the Fed, they all say we want to get to the neutral rate. So that's the rate where policies neither accommodative or restrictive. And we think that rate's only probably 1.25 to 1.5. They think maybe it's 2 to 2.5. But that gets determined by the 10-year. That's why the 10-year is also important. So the 10-year is at 2, like we're predicting, then you'd want to be at 1.25, 1.5. If it's 3, then maybe their number of 2 to 2.25 makes more sense. So we're bullish about this Fed meeting coming up. We think that just even if it's more hawkish than we're expecting, you're going to get the dot plot. So keep in mind, end of every quarter, you get the dot plot. So then instead of pundits getting on the TV and say, well, there's going to be 20 rate hikes this year or some crazy thing where a lot of people were on the 50 basis points, which is clearly not going to happen. So that you're going to have, well, this is what the FOMC says. This is their dot plot. So unless things have changed a lot since that meeting, we're going to know what they're planning. And we think it's going to be a little bit more dovish than what the market thinks. So we're going to play that as a positive inflection. And obviously, that's not the only thing going on. You've got the Ukraine war and whether we're going to have a peace agreement or what's going to happen there. So it's not the greatest time to get super long, but we do think the Fed is, going to be better, and the outlook is better with regard to Fed policy than the average investor believes.
And you both touched on leverage a bit, right? Leverage right now is a good or bad thing, right? If you know what you're doing with leverage, it works great. If you don't, it can be a real problem in terms of how you manage assets. Jay, you've got a slew of solutions that I think have some leverage on them. Speak to us a little bit about how that works.
Well, I think that another macro point is that there's some confusion with regard to tech stocks and interest rates. Everybody says, oh, well, tech stocks have super long duration. That's why they're going down. But really the key driver is the reduction of liquidity. Then that tends to take the momentum out of the market. Overvalued stocks come in. And by the way, high beta stocks tend to do very poorly. So, but what we believe in is not high leverage. So, of course, not these triple leverage funds, but modest leverage, 20 to 30% on low volatility assets with high income. So then instead of just making a choice between, well, I can buy Tesla or I can buy a 30-year bond, we're kind of in the middle. You get attractive returns, attractive income, take less risk in most markets than a regular equity, even like a utility, and get higher income. So if you're going to do modest leverage, I think it is good to outsource it because we're watching the markets really 24/7. And so we have a pretty good sense of where things are going. So like during the pandemic, we took the leverage off of all of our funds until really we found a bottom, which is the Fed intervention. And then we slowly put them back on. So if you want to spend your whole life doing that and trade the futures and watch CNBC all day, then you could do that. But it's not the easiest thing in the world to do. And, of course, I've experienced running highly levered funds where you would hedge with puts and calls, which we don't do in our funds. But so it's kind of like the David Letterman, don't try this at home. But if you have professional management, we think it's a great way without adding a lot of risk because we're levering lower beta stocks to add income and add return.
Yeah. Before going to James one more time, I want to hone in on something. You've got a suite of solutions, Jay, that offer different levels of dividend income. What is that range? Just so we have a sense of it.
Basically 6 to 9%.
Yeah. So you're getting your money back by investing in those kinds of things fast.
Correct.
Right? It's an important aspect of investing. And I guess, James, that was part of your point earlier, right? That income can really serve as a balance for high net worth individuals who are perhaps concerned about inflation.
Yeah, without a doubt, if you have a 5-year time horizon and you have you need to make a decision: do I buy a 5-year bond that's going to pay me, 1.5%, or do I buy something that has some equity exposure that's generating 7%? So over those 5 years, assuming that the dividend stays level, that's a 35% expected return over that period of time to mute any principal volatility, or help mute principal volatility, let alone if that volatility works in your favor and enhances your total return. So for a lot of people, the risk reward in this environment does shift, more towards equity driven types of income, where that rate of return is accelerated, especially if you have some time horizon, because that rate of return compounds. If you're comparing it to a 10-year and you're generating 7% a year, by design, you're looking to have a 70% expected return during that period of time, non-compounded. That's going to help mitigate some of your concern in terms of principal movement. So 100%.
Yeah. So Jay, I want to circle back to you on energy, because there's a lot of discussions now about energy policy here in the States, and there's a lot of consideration around whether or not that should be changing. I mean, do you have a view on that?
Yeah, definitely. I'll just make one technical point, because we interact with advisors like Jim, and we tell people, oh well, our portfolios have higher yields and so have higher interest rate sensitivity, but we just recently quantified that. So it's called duration. It's the weighted average maturity of the cash flows. So to validate what Jim and you were saying, a preferred stock or any stock that yields 7 has a duration of 15 years, whereas a 4% preferred has a duration of 22 years. And then, by the way, a 30-year bond has a duration of 22 years. So those are measurements of how interest rate sensitive they are. So it's actually risk reductive to have the higher yields with regard to interest rates. So anyway, I just wanted to share that research because I just quantified that. I knew it was true, but I recently quantified that. But with regard to energy, I was called by a reporter today, and I don't try to be very political, but the really key mistake that's been made, mostly in Europe, thankfully, and not so much in the US, just because the current administration hasn't been in power very long and is mildly ineffective. But the key mistake is to not focus on eliminating coal. And by the way, this isn't a political comment. That's COP26 was the global climate change confab. And what they recommended was eliminate coal and have global, not regional, cap and trade. So in other words, let the market, first of all, just get rid of coal, which is unambiguously good for us in the East as well, so we don't breathe coal dust. Get rid of mercury, SOx, NOx, and the worst source of carbon. 44% of all carbon comes from coal. But to do that, you absolutely need to substitute in natural gas, which, by the way, is 4 hydrogen atoms, 1 carbon. The only way to transport hydrogen efficiently is attach it to 1 atom of carbon. So you need natural gas. So that was the mistake Europe made. They eliminated their natural gas. That's why they're going to have a recession most likely this year, even before the Ukraine war. Their natural gas was 10 times as expensive as the United States, which prices electricity. So there's a simple path to improving the environment, eliminating or reducing carbon, produce way more natural gas, which is easy to do in the United States, shut down all the coal, pay people who may be disadvantaged by that, and then have a global cap and trade where there's really what's going to happen, there's going to be 1,000 solutions to the problem, not one. And it's not, by the way, electric cars, because they use hydrocarbons because they use electricity. So that's kind of the key mistake. And that's why we're cautious about investing in Europe, overseas. We think the United States is the best place to be, because we're going to benefit by having 10% of the energy cost of the rest of the world. Manufacturing is going to boom, chemicals, materials. We're going to produce more natural gas. So there's going to be a manufacturing boom in the United States because of that built-in advantage we have.
So from a political standpoint, not to talk politics, that's not the concern so much. Do you think that the companies in the energy space are going to be allowed to produce a lot more?
I think they will, up to a point. The only real constraint, what the Biden administration did, because they clearly were anti-hydrocarbon. Their platform was formed with Senator Sanders as like 50% of all the committees. And they were clearly anti-hydrocarbon. They should have been in, again, I'm anti-coal, pro-clean energy, which is hydrogen plus 1 carbon atom, which is natural gas. So they clearly were negative. They restricted drilling on federal lands and even infrastructure on federal lands. So that's a big deal. And they canceled the Keystone Pipeline.
Yeah.
So the reporter I was talking to today said, well, is the Keystone Pipeline very important? Maybe not. But guess what? There are no pipelines being built right now in the United States because you need the federal government to support it because the states and local people don't want it. Like, do you want a pipeline through your summer house in Long Island? No. Do you want one in upstate New York? No. Who's going to make you? The FERC and the federal government.
Okay.
But if the FERC just tightened up natural gas pipeline approvals, they have to have carbon, analysis, which means basically they're not going to happen. So up to a point, there'll be production, and then transportation will get limited. So there is probably a cap. And I don't see that policy turning around overnight. But by the way, it is in Europe because they don't have a small problem. They've imploded. If in the United States, people would be on the streets. I mean, we would have recall elections in every state. People aren't paying a little bit more for energy like they are in the United States. They're paying 13 times as much. It's almost unimaginable. Like my electric bill is about $500, let's call it $500. So instead of paying $500 a month, I'd be paying, $6,500. Nobody's going to tolerate that in the United States, and they're not going to tolerate that in Europe. So they're going to fix the problem, and they're going to produce more natural gas, not because they necessarily agree with it or think it's, the greatest thing to do from a virtue perspective, but they just are required to not go bankrupt.
Yeah, the fact of the matter is it's a global issue, right? And I think people forget that. They're so focused on the fact that at the pump their individual cost is going higher, right? So James, speaking about energy a little bit, do you have a good amount of exposure to energy? I mean, do you focus in on sectors as well as the broad markets?
Yeah, we try to be tactical, and we do have exposure to the energy spectrum, and in part, the energy spectrum is not only timely, not only cyclical, which fits in thematically with our view, but they also happen to be value driven, and they throw off typically a lot of income. So our view, we were fairly early in on that trade and in that allocation. And we've rebalanced a little bit recently with the recent ramp because some of these companies went parabolic, like I don't want to mention names. Sorry, but yes, the answer is yes. It's part of most portfolios.
Yeah, I get that growth. Will have some headwinds in the markets right now. I think it might depend on which growth areas are more sustainable than others. But value definitely seems to be tilting the way of portfolios right now. And it's rational, right? The irony is what the S&P right now is yielding like 1.3, 1.4%, Jay. I mean, that seems awfully low, right? Mm-hmm. So tilting towards dividend strategies makes a whole lot of sense. What's the kind of makeup that somebody should expect in the way of your dividend strategies on your equity side?
Well, first, just to add to what Jim was saying, we recommend if investors do want to play energy, that you go after the dividend stocks. So that's like super majors. A couple of the producers have distribution policies that get you 5, 6, 7, 8. But we don't like value with our income because value sometimes doesn't do anything. Is not obviously not momentum. So we want to get paid to wait. So that would be kind of another headline. Don't do value stocks. Like I don't want somebody trading at 5 times earnings. It pays no dividends. Like General Motors right now does that, for instance. So we wouldn't necessarily recommend that. If we're going to get 5 times earnings, we want like a 5% dividend yield. So what you can do, even though the S&P yields 1.3, 1.4, if you screen the S&P and look for the highest dividend stocks, and then we curate them to look for the companies that are lower risk, lower multiples, and aren't in super cyclical sectors like technology, you can build a portfolio with almost a 5% yield. Obviously, you're going to have a lot of REITs. You're going to have a little bit of non-traditional, but you don't have to over allocate because we agree with Jim in the sense that we believe in get rich slowly schemes so that you basically never have any significant industry concentration nor stock concentration. Because keep in mind, we're not running these companies. We're not the CEO, so we don't know what their strategy is going to be. Maybe they change their name from Facebook to Meta. I may not like that if I'm, maybe I don't agree with that, but wasn't my decision. So if I have a 1% position, I could sell it or double my position. If I had a 10 and it's down 30%, first of all, I've lost a lot of capital and I don't really feel like adding to it. So we believe in fully diversified portfolios and small allocation to individual stocks, but you can still, even using those criteria, build these high income portfolios that are massively defensive. If you look at the index, one of the indexes we track, it's actually up for the year where the S&P is down double digits. And even if the S&P was up 20%, it probably still would be up and you'd still be getting your income. So we like defensive dividend stocks because they're all weather securities.
Yeah, all weather is a key commentary, right? Because things are tough. So would you consider, Jay, any of your strategies in the alternatives bucket, by the way?
Well, I guess just only to the extent that you define alternative as less well understood. Where they're not alternative, and what I've learned from running hedge funds, is you don't really want to be in illiquid assets. So these are all listed liquid. We don't trade in the unlisted preferreds. So from that perspective, normally when I think of alternatives, I think private equity and hedge funds and gates and low liquidity. So it's not from a liquidity perspective, but yes, I think they are less well understood. And they do really require not necessarily professional management, but active management. Like you said, if you can go into Barron's and say, oh, well, this is a great security, preferred security, it yields 8. But if you don't notice it's trading in 26, callable at 25, you could lose money. So not necessarily professional management, but definitely active management. But there's still, like you're saying, all-weather securities, and you can build these portfolios with high yields without taking any big bets. So we don't recommend, big bets or big risky moves like all in on energy, all out of energy.
We've seen a good amount of new ETFs and flows going into the alternative space. That's why I asked. I think this is going to be a key test for hedge funds right now. How have they managed this kind of volatility and delivered low vol strategies? So I'm definitely intrigued by the future here in that regard. James, are you invested in alternatives?
I am, and it's very bottom up, and our focus is very simple. It's generating alpha in a premium price platform. So and typically it's in search of non-correlatable positions and sleeves. So we have. And we've been very fortunate. We've been successful at it. But generally speaking, I think there is an appetite for low cost alternative platforms that obviously don't correlate to the markets, and hopefully may even be able to provide some smart beta in the process.
The thing of it is, alternatives always sound sexy in the context when the markets get like this, but liquidity matters, right? At the end of the day, that's clients need liquidity. So I appreciate, that's why I present the question, right? So we're going to be heading towards the conclusion pretty soon. We've got a couple more minutes. Jay, do you have any some further thoughts on markets?
I think that I would focus on the Fed ultimately. The Ukraine situation isn't likely to affect the U.S. economy. In fact, like I said, it's of course a massive tragedy and probably the worst thing that's happened maybe since World War II. But that keep in mind that the U.S. Free market is intact, notwithstanding any administration policies. And so we have this unprecedented advantage over the rest of the world with this abundant natural gas. So we're very bullish about the U.S. economy. We're bullish about the Fed. We don't really know exactly how Ukraine's going to end, so that's a risk, but a lot of it's priced in. So we're not kind of wildly bullish because it's definitely dicey when the Fed's tightening policy. It's way better when they're crazily injecting liquidity during market booms. But what we do, it's actually benefits from it because people leave Bitcoin, rotate into some of our stocks. That's why some of our funds are up or basically flat for the year while the market's way down. So you can actually, by being conservative in these markets, do really well because you get the benefit from the flows from momentum stocks. They're overvalued to these stocks. And just one point, because there's a lot of controversy about the ARK funds, et cetera. It's nothing to do with interest rates. These stocks, because of the Fed, were massively in a bubble and way overvalued. It doesn't matter whether the 10 years at 150 or 2, okay? There was no DCF that had Peloton, which manufactures bikes, a low margin business, to be $180. I don't even know what it was. I think it might have been, I don't know, some ridiculous $100 billion. That's just a mistake. So that's why we're benefiting from these flows, is that was just flat out overvalued. And that's why you'll see Zoom is now trading at a reasonable multiple, but it still went down when it reported earnings. So that stock was at 600, now it's at 100. So there was a bubble, and those investors are getting burned, and they're gravitating towards the get rich slowly schemes of owning these dividend stocks. So I think this year it's totally fine to be in those stocks, and I think you're going to significantly outperform the market like you already have.
Jay, I've got a question from the audience. Lily Poi writes, and I'm going to kind of ask the question a little bit differently because she writes, would you include MLPs to generate income, pros and cons? So knowing you, yes, the answer is yes, but what are the cons, right? What are the risks?
Keep in mind that I founded an MLP and we really took, quite a hit from MLPs. So when we get complaints from advisors and their clients, you're preaching to the choir. Okay, so just to be clear, but there's a simple way to deal with more volatile securities. And by the way, MLPs have calmed down and pipelines have calmed down. They're less volatile than they have been because they've restructured. They have lower leverage, higher coverage. They're buying back stocks. So they're a better asset class than they have been. But a simple way, given that fact, a simple way to deal with it is, as I was mentioning before, just have a smaller allocation. So if you're 5% in utilities and 5% in REITs, well, why don't you be 1% in MLPs? Because, you say, oh, well, why bother then? Well, 1% times 9, that's a lot of, that's still a lot of income. If you're trying to get to 4, that's still decent, kind of starts to move the needle, or maybe 2%. But don't make it 10, because then you're going to get questions from your clients and you're really exacerbating the volatility. But we do like the asset class. It has restructured. Everybody has PTSD, but when you enter markets where people have PTSD, a lot of times you get outside returns.
You mentioned 9. That's a high yield.
Yeah.
James, any concluding thoughts?
I think it's the new environment has changed the playbook for speculation. And I think there's a realization that fundamentals matter, and it's going back to basics. Buy great companies with good cash flows that throw off good income. Look for as much return as possible in instruments that you understand, and make sure that you have an allocation that allows you to sleep at night. And I think it's this push back to fundamentals. The environment of gambling and speculating on some thematic names without recognition to valuation and simply playing price is yesterday's playbook. I think you want to own high quality names that throw off income. And I think in some of the more hybrid areas of income generation, you want to outsource that task, whether it's in the preferred space or in other, spaces that are income generating. because it does require a certain level of expertise. And I think you just keep it simple in this environment.
And if people want to reach you, Jay, do they call you directly or do they call Craig Starr?
Well, if you're welcome to call me, and I'm probably going to return your call. But if you definitely want to return, you can call Craig Starr, and can arrange a meeting. But we do like talking to clients or potential clients, so feel free to contact us either over Bloomberg, or we do this thing called telephone tag, so our lines are open.
And James,
yes,
if people want to reach you, how do they find you?
They can call me, they can email me. I'm accessible multiple forms. So
and you're on LinkedIn.
And I'm on LinkedIn also, yes.
Okay.
Thank you.
Yeah. So James, we always like to highlight a charity, and we give the opportunity for the financial advisor to make the choice. I think I have the charity in the chat. Talk to us a little bit about the charity.
So, obviously what's happening in the Ukraine is a tragedy, a human tragedy, a tragedy on every level. And I think that, our hearts go out to the Ukrainian people. So Rhizome's been a philanthropic organization that's been there for years, and that is at the forefront of providing, medical supplies to, the parts of the Ukraine that are in desperate need of those medical supplies. So they're a well-known organization, and they've been around. They've got the infrastructure to distribute these supplies, and they do it in a cost-effective fashion. And anything that we can do to obviously help the Ukrainian people, I think, will go a long way.
Thank you both for the time. I hope everybody found this call constructive. Your insights were of great value. So have a good day. Be healthy.
The views and opinions expressed during this event are those of the participants and do not necessarily reflect the views of the sponsor or organizer. Information set forth during this event has been obtained or derived from sources believed by the participants to be reliable. However, neither the sponsor nor the organizer make any representation or warranty, express or implied, as to the information's accuracy or completeness, nor does the sponsor or organizer recommend that the information shared during this event serve as the basis of any investment decision, and it has been provided to you solely for informational purposes only, and does not constitute an offer or solicitation of an offer or any advice or recommendation to purchase any securities or other financial instruments, and may not be construed as such. Past performance does not guarantee future results. This interview is being distributed for informational purposes only and should not be considered as investment advice or recommendation of any particular security, strategy, or investment product. It does not constitute legal or tax advice. The information provided is not intended as a complete analysis of every material fact, and the underlying assumptions and views are subject to change based on market and other conditions. All investments involve risks, including possible loss of principal.